So my name is Jonathan Simon. I'm one of the two principal portfolio managers of the JPMorgan American Investment Trust. I have spent the bulk of my career, actually more than 30 years, being based in New York with JPMorgan Asset Management as an equity portfolio manager. Interestingly, my co-PM, whose name is Tim Parton, has a fairly similar profile. He moved to New York, I think, in the early 1990s, so just over 30 years ago, and he's also been a specialist in US equities from that date. So we have a lot of similarities, and we are co-portfolio managers of the JPMorgan American Investment Trust. Well, the question often comes up as to why invest in the United States, and the first answer is clearly that it is the largest equity market in the world. In fact, it makes up some 60% of all global equity markets. But not only that, it also offers diversification across pretty much every industry. We always think about technology and the leading companies and the innovation that comes out of the United States. But also you have financial services and healthcare, industrial manufacturing. Pretty much every sector of the global economy is covered by first-rate companies that you can invest in the United States. JPMorgan American Investment Trust has 90% of its assets invested in what we call a core portfolio, which is managed by Tim Parton and me. And it's a very concentrated approach. So we only own 40 stocks in total. But in the case of Tim, he's investing predominantly in growth companies in the US, and I'm trying to identify value opportunities with the other 20 stocks in the portfolio. And what this means is that over time, we don't necessarily do well or badly in a particular market environment. So we think that blending growth and value into one core portfolio gives the best of all worlds for an investment in the US equity market. Clearly, having a portfolio with only 40 stocks is a fairly concentrated approach. So we're making active decisions, and of course, it's available in the investment trust vehicle with low expenses, and over time has proven to be not only a good exposure to the US market, but to do a little bit better than the average investor. We both are looking for the same sort of quality characteristics in the companies we invest in. So these are typically very strong business models within their industry. They may have a very high market share, and in particular, they have strong management teams. Now, Tim, of course, is a growth investor, and he's really looking to grow value by investing in companies that have a strong tailwind from what we call secular growth in their particular industry. Whereas I might be investing in companies that are in more mature industries, but where the cash flow and the earnings are strong, and we may get good dividend growth, and we may find shareholder value growth in other ways. And when it comes to identifying the right management teams, of course, with a concentrated portfolio where every holding really has its own significant risk and reward, we really want to find managements who have skin in the game, who have their interests aligned with ours. So we'd like to see them have a significant equity ownership themselves, and that be the important driver of how they think about managing the company. They think about the risks. They think about how to grow the value over the long term. And so insider ownership, as we call it, is an important characteristic. Now, obviously, these companies, there does come a time when we need to move on. And so for me, particularly as a value investor, we've identified a good company, it's an attractive valuation, and a few years later, lo and behold, it's in favor and it's a very high valuation. And we feel that's time to maybe recycle into another similarly good company, but one that's not so much in favor and is trading at a more attractive valuation. And that's always a good thing, because it normally means we've made a nice return in the interim. There are a few occasions, I have to admit, when we realize that our analysis of the prospects of the company, the fundamentals as we call them, are erroneous. And so there are times when we have to move on because we've made a mistake. Normally we're fairly quick to do that. And generally there is another good alternative to replace the company with. So the interesting thing about both Tim Parton and me is that we've been based in New York with JPMorgan for, I think, probably 30 years in the case of Tim, and a little bit longer for me. And being part of JPMorgan, we have the best resources available. We're obviously one of the biggest asset managers in the world and have one of the biggest US equity research departments. So it's a great comfort for me when I identify a company that there's an analyst who spends much more time than I do researching this particular name. He or she will have much more knowledge of the company. They'll know the management probably personally. And so it's a great resource that we have available. In the case of Tim, he actually has a dedicated team of growth stock analysts supporting him. The other thing about being in New York, of course, is that company management teams do like to come to New York, and typically JPMorgan will be a port of call for them. So typically we can actually converse with the management teams in our own office in New York on a fairly regular basis. Now, naturally, over the course of 2020, 2021, that wasn't possible because of the COVID restrictions. But I have to say that we continued really without missing a beat, interviewing management teams over Zoom, Microsoft Teams, whatever the method was, and it continued apace during that time. Now we're almost back to normal. Well, one of the great advantages of an investment trust is the ability to keep the expenses low. So we think that the expense ratio for the JPMorgan American Investment Trust makes it a particularly attractive vehicle. But in addition to that, we can use what is called gearing. So this means a very modest level of borrowing against the portfolio. So we can issue debt at a low cost. And if you assume that over time that the returns from the US equity market, and I'm talking long term, will exceed the cost of that borrowing, that too will enhance the ultimate returns to shareholders. Now, I'm not talking about a huge amount of debt here. Typically up to about 10% of the overall portfolio, which we do not consider to be, a significant risk overall. So that to me is something that other investment vehicles cannot offer, and enhances the JPMorgan Investment Trust's appeal. We also have an exposure to the smaller companies sector in the United States. We have a strong investment team focusing on smaller companies in the US, and again, we'll vary the exposure to that segment of the trust over time depending on how we see the opportunities, but it typically makes up between actually 0 or 10% of the overall portfolio, and we think that's another advantage we have for the American Investment Trust.